We had some huge earnings call this week with most of the FANG stocks reporting. We had Facebook, Apple, Amazon, and Google all reporting on the same day, and also Netflix also announced their earnings call earlier this month. So let's go ahead and jump right into the takeaways. So starting things off with Facebook, Facebook did have a nice top and bottom line beat with earnings per share coming in at $2.40 versus $1.91 expected. So a really nice beat there. And as far as revenues, they also had a nice beat here as well. They reported $21.4 billion in revenue compared to 19.8 expected. Now, moving on towards daily and monthly active users, the users in US and Canada were slightly lower than the previous quarter. The reason being was that they had elevated user activity in Q2 due to COVID, and as a lot of people were at home, user activity was naturally much higher. Also, daily and monthly active users are expected to be flat or even decrease for the next quarter. Now, this is somewhat relevant as the average revenue per user for Facebook is at its highest in the US and Canada market. But however, I don't think this is too big of a deal. Reason being is because the Facebook monthly active people, which is Facebook's way of mentioning all of the users in all of their platforms, did actually grow to 3.21 billion from 3.14 reported last quarter. So the way I look at it is that they still have a massive user base and the most popular social apps out there. Okay, so going back to revenues, in quarter three, Facebook's ad revenue was up 22% year over year, which is really good growth, but they now also expect the fourth quarter ad revenue to grow at an even higher growth rate due to the upcoming holiday season. So basically, Q4 for Facebook, ad revenue is expected to grow more than 22% year over year. And honestly, I wouldn't be surprised if Facebook can hit $26 billion in ad revenue next quarter, which would be equivalent to a 25% increase year over year. We're going to have to wait and see, but I do think that they can pull that off. So overall, this was a solid earnings report for Facebook. And as far as the stock, I really like Facebook. And as we can see by the numbers, Facebook is still a growth beast and trades at a pretty good valuation, especially now that the stock did dip down after the earnings call. We're looking at about a 26 forward PE. And with Facebook's growth, it's actually pretty attractive in my opinion. However, I don't own any Facebook shares just because it's not a dividend stock and I mostly focus on dividends. But hey, if Facebook ever starts paying a dividend, I'll be the first in line to buy some shares. Next up, we got good old Apple. So they too announced a top and bottom line beat as well. Earnings per share came in at 73 cents versus 70 cents expected, and then revenues also had a nice beat with 64.7 reported versus 63.7 expected. Now, as far as revenues by product, Apple did have beats pretty much across the board, especially with service revenues continuing to grow at a double-digit clip. But however, iPhone sales were down 20% year over year. Now, with that being said, iPhone sales weren't going to be good to begin with. Expectations had iPhone sales declining 15% year over year. Now, the results were a bit worse at 20%, but I think most people were holding off and upgrading their iPhones just because of 5G and maybe some other factors. And I also think that the iPhone 12 is going to be a good buy and worth the upgrade for a lot of people. I honestly think that iPhone 12 has a great opportunity to be successful for Apple, and we'll hopefully get to see that in the next earnings report. So right here, I pulled up this chart which shows Apple's Q1 iPhone sales, and Q1 for Apple, again, basically is the quarter in which they report when they have their newest iPhones in the market. And I'm probably going to be off on this, but I can see iPhone sales in Q1 for Apple being 60 billion, if not over, similar to 2018 when they released the iPhone 8 and iPhone 10. Again, this is just a shot in the dark, but I do think that Apple could hit between $60 and $62 billion in iPhone sales next quarter. Anyways, even if iPhone sales aren't too good, the important stat for Apple ultimately is service revenues in my opinion, which by the way, grew at a double-digit clip year over year every quarter this year. That being said, Apple has now launched their new Apple One subscription bundle. They basically have three tiers. individual, family, and premier. And to me, it does seem like a pretty good deal that they're offering. And I'm sure a lot of Apple users will end up subscribing to it. So yeah, I think it's a good deal. I think Apple One is going to help Apple continue to grow their service revenues at a double-digit clip, hopefully for all of 2021. And also, this just shows how Apple is basically paying more attention to being more service/subscription based. And I think that's a business model that Apple could ultimately thrive in, honestly. Now, as far as the stock, I have said it before and I'll continue to say it again. Apple is a really good investment at any price if you're dollar cost averaging. However, if you want to be more selective with the valuation, I never really liked Apple trading at forward multiples in the mid 30s. I honestly think that's way too high, but I do think that a forward PE in the high 20s is somewhat fair, and in the mid 20s a pretty good deal. Now, Apple was down after the earnings reports, which I think is mostly due to the fact that they didn't provide any guidance for the next quarter, and possibly also the stock cooling down just a bit. Alright, so next up we got Amazon, and just like Facebook and Apple, they also had a top and bottom line beat. Earnings per share came in at $12.37 versus $7.53 expected. So that was a huge beat as far as earnings per share. Revenues went ahead and came in $96.1 billion compared to $92.7 billion expected. Now, these revenues are up 37% year over year, and this just shows how Amazon was able to thrive even during the pandemic. However, it's not all positive news when it comes to Amazon. We did hear that they were facing some headwinds when it comes to productivity. And when you have such an increase in demand as far as online shopping, combined with having to enforce social distancing measures at the warehouses, productivity does become a challenge, and being able to meet demand and delivery times could be challenging. And I think Amazon felt that a little bit as they forecasted for the next quarter to have about $4 billion in COVID related expenses. But overall, Amazon had a good earnings report. They had strong numbers in free cash flow, in sales, and in net income. And the stock was actually down after the report. It could be due to the fact that they did give a guidance for the next quarter, but it was a very wide one. And also the stock, I do think, was cooling down a bit as well. I do like Amazon, kind of like Facebook. The only reason I don't own it is because it doesn't pay a dividend, but also Amazon does tend to trade at a pretty premium valuation. So just be careful when buying Amazon. Hopefully you can get a better deal now that the stock was down after the report. Next up, we got Netflix. So Netflix had their earnings call earlier in the month, and they actually missed on earnings per share. They reported $1.74 versus $2.14 expected. Now, as far as revenues goes, they did have a slight beat on revenues. They reported $6.4 billion compared to $6.3 billion expected. So that was a very small beat on revenues, and they did miss on earnings. Now, as far as new net paid subscribers added, Netflix came short of expectations. Now, to Netflix defense, they did receive a huge number of subscribers earlier in the year due to COVID and everybody signing up for streaming services, and it does make for the growth on the subscribers to slow down a bit. I mean, they had over 15 million new paid subscriber additions in Q1 this year. Now, they did recently announce that they will be increasing their prices on their subscriptions for their standard and premium plan, and I think this was actually a pretty good move, especially after the fact that they missed on earnings per share. But now the only question is if they're going to lose some subscribers as they increase prices. I like to think that it's probably not going to affect their subscriber growth, but we're going to have to wait and see on the next quarter just to see how these subscriber numbers do. Now, switching gears to production, Netflix was negatively affected by COVID in this regard, basically slowing down the productions for their new shows. However, we did hear that they already restarted production, which is a good thing. Now, as far as the stock, I am a fan of Netflix, but I do think that there's a lot of competition coming into this space. We got Disney, Apple, Amazon, etc. And I think the multiples on Netflix are eventually going to have to come down as more players start entering this space. Now, Netflix trades at around a 55 forward PE, and I do think that is pretty pricey in my opinion, and not the best deal out there. So last up on the list, we have Google, and they too also posted a beat on the top and bottom line. Earnings per share did come in at $16.40 versus $11.20 expected. And as far as revenues, they also had a beat here with 46.1 billion reported compared to 42.9 expected. Now, this huge beat comes at a good time since last quarter, Google did post their first ever year-over-year decline in revenues. I believe they had a negative 2% growth rate in the last quarter, and I do believe that COVID did play a role on Google's revenues as ad rates were lower during that time. But it does seem like ad rates are starting to climb back up, and it's also nice to see that Google was back on track with a nice double-digit growth rate quarter year over year at 14% for their top line. Now, as far as the stock, I actually really like Google as well. Kind of like Facebook, they both trade at reasonable valuations and they both have solid growth rate moving forward. I believe Google's trading at around a 28 forward PE, which is pretty nice. Well, that's pretty much it. Those were my takeaways from the popular FAAN stocks that all reported in October. Hopefully the video was helpful, and thank you so much for watching.